Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar.
I received this query. How to understand the changes in inventories of finished goods and work in progress and stock in trade as shown in negative. If the mentioned head is positive, how it will have effect on the overall expense. If company has sold more products, it should be on positive. Okay, so it's linked to that. So the question is basically, what is the interpretation of the changes in inventories we see in the income statement? Because in an income statement, you will have top line, that is sales, then you will have various cost, and in that cost you will see this particular line item called changes in inventory. It may be a positive figure or it may be a negative figure. So many has this question, what does that positive figure communicates, or what does that negative figure communicates? Why a positive figure under expense, or why a negative figure under expense? Why it is not given that right presentation? Let's understand that now. See, we are basically talking about inventory. Even though the question was with respect to only the work in progress and the finished goods, I wish to cover all the three. See, when we say inventory, basically it's a composition of raw material, work in progress and finished goods. As far as the raw material is concerned, we will not get this question at all, because in the financial statements, in the income statement, the raw material presentation will be clubbed. Here you will basically have raw material consumption. So raw material consumption is nothing but opening stock of raw material plus purchases minus closing stock of raw material. So within this raw material consumption, both the items, opening stock and closing stock, is taken care. The calculation will be done inside, or it will be available in the schedule, and only the net figure will be shown in the income statement as a single line item. Had it been split like raw material purchases, then change in raw material, a positive figure or negative figure, again that would have given rise to the question, what does that change in raw material communicates? But thankfully it is clubbed in this calculation, so many will not get question on that aspect. And raw material consumption is also very simple. I mean, logically you can understand it very easily. You had some raw material in the beginning of the year, then you purchase something, and at the end of the year you are carrying some raw material on hand, means the balance is consumed. That's why we have the formula opening raw material plus purchases minus closing raw material is equal to raw material consumed. In the similar way, we also have this work in progress and finished goods. Okay, but they cannot be added or subtracted from a single line item. Unlike raw material, where the opening and closing is very much related to the raw material purchases, the other two items cannot be done in that fashion, because they are a result of composition of various other costs as well. Work in progress, finished goods, they have raw material, labor, overheads, everything is included. Okay, so that's the reason the changes in inventory is presented in the income statement, basically deals with work in progress and finished goods, and raw material is taken care under raw material consumption. Okay, so this is the background I want to set. Now coming to the question. how to understand the changes in inventories of finished goods and work in progress. For explaining this, I'm going to take a simple traditional format based explanation. Then I'll come to vertical one. Now look at this. I'm going to call this as scenario 1 and this is scenario 2. Scenario 1, I'm preparing a traditional trading account. So this is basically in T format. You have left hand side, right hand side. We say debit side, credit side and all. Okay. Assuming it's a newly started unit. Let's say they are starting their operations on 1st April 2020. So they don't have any stock. They have to purchase. So opening stock is 0. Then on various dates, they are purchasing around 100 units at the rate of 80 rupees per unit. So 100 into 80, they have spent overall 8,000 rupees. Okay. So ideally, their cost should be opening stock plus purchases. They didn't have any opening stock. So purchased 100 units at 80 per unit. So 8,000 is their only cost. Then they have to sell these units, right? On various dates, they manage to sell 90 units at the rate of rupees 100 per unit. It means 90 into 100, 9,000 is their sales. Okay. Now listen carefully. Going by the layman calculation, what the layman will do, layman will say he spent 8,000 and purchased goods and he sold them for 9,000 and he made a profit of 1,000. This is layman calculation, but here we cannot do layman calculation because you purchased 100 units and you have sold only 90 units. It means 10 units still on hand. Okay. So ideally what you should do, if you want to find out the profit, you should compare the sales of 90 units with the cost of 90 units. But the traditional trading account is in this particular format. So you cannot go and do the adjustment here. So what the traditional format followed is, whatever the units that are not yet sold will be captured separately. So you will be able to arrive at the fair profit. In this case, what will be the fair profit? Let's do that calculation. Look here. 100 units purchased at 80 per unit. But how many units were sold? 90 units at the rate of 100. So 90 units at the rate of 100, sales is 9,000. So what is the cost of this 90 units? 90 into 80 per unit, right? So 7,200 is the cost. So it was that 7,200 worth of products were sold for 9,000. So 9,000 minus 7,200, 1,800 is a profit. But how that can be presented? It can be presented by capturing the closing stock. And when you put that closing stock in this traditional format, you will land in the fair profit. How? You have purchased 100 units and you have sold 90 units. It means there is a closing stock of 10 units. And it is valued at 80 per unit. So closing stock of 10 into 80, 800. If you capture this, what you are actually doing is, from the purchases of 100 units, you are subtracting 10 units because purchases 100 units is on the debit side and closing stock you are writing on the credit side. So this is like plus and minus. So 100 minus 10. Or say 8,000 minus 800. So effectively you are capturing net 7,200, which you are comparing with the sales of 9,000. So that will give the fair profit. Yes. So that's what we are going to do here. So 9,000 plus 800, you get 9,800. We'll take that total over here as well, 9,800. So from this 9,800, if you subtract the opening stock, which is 0, and purchases 1,800, you get this balancing figure, which is nothing but 1,800. And this is the gross profit, which we have calculated as well. So look how it does the job. Because layman will be believing that they have spent 8,000, they have made a sales of 9,000, they have made a profit of 1,000, but their profit is not 1,000, it is actually much greater than that, because out of this 100 units, 10 units not yet sold, we knocked it off by taking it to the credit, and then we were able to arrive at the gross profit. Now this is the traditional method, okay, traditional format. You will not see this kind of a format for companies and all. Maybe for sole proprietorship or partnership they'll prepare it in this format, but you won't see this for companies. They'll do it in a vertical format. So how it will happen in vertical format? Look at here. I've just presented the abridged format. The same. The sales of 9,000 is captured. From that, total cost will be deducted. So here is where the understanding required. Now, what is the total cost for achieving this sales of 9,000? Is it this 8,000 rupees? Yes, it was 8,000, but of that 8,000, still 800 is not yet consumed. So we cannot say cost is 8,000. It is 8,000 minus 800, right? So that's what the vertical format takes care of. You take the total cost, you arrive at the total cost by factoring the purchases, which is what you have here. And with that, you will add opening stock. Why we are adding opening stock, you will understand gradually. Okay. And you will subtract closing stock because to that extent it was not consumed. The closing stock what we captured here, it's getting subtracted. So now you get the clear picture as to what is the total cost, which is 7,200. And when you compare the 7,200 with the sales of 9,000, you arrive at the profit of 1,800. Obviously they are one and the same, but I think this is even more understandable, right? Because you are arriving at the total cost. You are saying you have spent 8,000 on purchases, and then you are saying no, from this 8,000 I want to subtract 800 because they are not yet consumed. They'll be consumed in the next year, they'll be sold in the next year. This year I want to arrive at the fair profit. I have sold 90 units, so I want to compare the cost incurred for those 90 units only, not for those which were not yet sold. Okay, so that's the logic. And here, if you notice, with this purchases, opening stock is added and closing stock is subtracted. Opening stock is added because this is carried from the previous year. In this case, I have made an assumption that they have just started their operation, so opening stock is 0. So in scenario 2 explanation, it will make more sense. It will make more sense. Let's see that. Let's continue with the same set of information for trading account year 2. In trading account year 2, that is next year, I am taking the opening balance. The closing stock of previous year will become the opening stock. Basically the 10 units at 80 rupees per unit, 800 becomes the opening stock. And on various dates, around 120 units were purchased at the rate of 80 per unit. For simplicity purpose, I have assumed the same rate per unit. Okay. So 120 into 80, it works out to 9,600. Now be very clear. In the previous year, the purchase cost was only 8,000. In the current year, purchase cost is 9,600. And in addition to that, you also have 800 carried from the previous year. This 800 was not at all accounted as an expense in the previous year. Why I am saying that? Because in the previous year it was taken to the credit. It means it was knocked off from the purchases. It was knocked off from the purchases, taken to the credit for the reason it should be treated as expense of the current year if it is getting sold in the current year. Okay. So basically for the current year you have 10 plus 120, 130 units. And on various dates sales are happening. Let's say around 125 units are sold at the rate of 100. Now look at here carefully. 10 plus 120, 130 units are there, of which 125 units are sold, and it is sold at the price of 100. So the sale price is 12,500. Now how to arrive at the profit? See, we know 800 plus 9,600, that is 10,400 is the cost, and the sale price is 12,500. But we cannot compare 10,400 with 12,500 because 10,400 is for 130 units. 12,500 is for 125 units only. So here this has cost for 130 units. I want to compare it. I want to make this comparable. This is for 130 units. I want to make it as 125 units. So what I should do? From this I have to deduct 5 units cost. So instead of doing the subtraction on the debit side, that is left hand side, I'm going to do it on the credit side. So here I'm going to do this calculation as at the year end, that is on 31st March 22. I'm doing this calculation, closing stock 5 units at the rate of 80 per unit, and that works out to 400. So by taking it on the credit side, what I'm doing, I'm actually deducting that from here. So from 130 I have deducted 5. It means I have 125 units on the debit side. I have sale of 125 units on the credit side. So now it becomes per se comparable. And then if I arrive at the profit, it will be the fair profit, and it works out to 2500. Now let's look at that here in the vertical format where things will be even more understandable. So here the sales is 12,500. So from where I got this 12,500, it's same this figure. Now for achieving the sales of 12,500, what is the cost I have incurred? I have made some purchases. This 9,600. Yes. Whether I achieved the sales with this 9,600 alone, if you ask me, answer is no, because 9,600 is 120 units. Whereas I have sold 125 units, so this sales is not possible without the support of opening stock. Correct? Okay, so now listen. For achieving the sales of 12,500, I have made a purchase of 9,600. And I have also used my opening stock of 800. Okay, so both goes towards my cost. But the question is whether I have used this entire 130 units. No, because I know sales is for 125 units, and this purchases and opening stock is basically 120 plus 10, 130 units, whereas this is for 125 units. So what I should do ideally, I have to knock off those unsold units. So from this total cost calculation itself, I'm knocking off the unsold units, which is basically 5 units, which is valued at 80 per unit. So if you see now, my total cost is coming down, because here I purchased 9,600, I added opening stock of 800, I believed my total cost is 10,400, but it is not 10,400 for achieving the sales of 12,500. Actually, out of 10,400, still 400 is unsold. It means remaining 10,000 is only my cost, and that will be compared with 12,500. So I can arrive at the profit of 2,500. That obviously matches here as well. Okay, so this is the logic behind the vertical format presentation. So what many statements will show is they will add the opening stock, closing stock will be deducted. They'll add opening stock, closing stock will be deducted. But the confusion comes when they net this. When they net this, people will get confused. Okay, because they'll say increase in inventory, decrease in inventory. What does that mean? Let's extend this understanding. Now let's focus only on these two. Okay. Now if you look at here, total cost, purchases is 8,000. There is no opening stock, but there is a closing stock. Now if you compare the opening stock with closing stock, opening stock is 0, closing stock is 800. So what happened to the inventory now? Inventory increased or decreased? Inventory increased. Okay. When inventory increased, what was the effect? What happened to your total cost? Originally, it should have been 8,000. But because of increase in inventory, the total cost has come down, right? So, what is the interpretation? If there is going to be increase in inventory, your total cost will come down, because you have incurred some cost already in terms of purchases, but some are not yet consumed. So increase in inventory means what? It will reduce your total purchases cost because something not yet consumed. The same thing happened here. You have purchased 8,000, but 800 not yet consumed. So your total cost has come down. So what is the interpretation? Whenever there is an increase in inventory, your total cost will come down. So instead of showing it as add opening stock less closing stock, some companies will prefer to show changes in inventory. They will simply say changes in inventory and they will indicate the figure within bracket or with minus sign. So if they are indicating within bracket or with minus sign, it is increase in inventory. This increase in inventory will be subtracted from the total expenses so that total cost will be arrived out. In this case, we believed total cost is 8,000, but since some of the inventory is not yet sold, total cost has come down to 7,200. I hope all of you are with me. If you understood this part, this concept, this element, just comment below this lecture, understood. Here, the understanding is simple because you didn't have any opening stock, right? So we just had closing stock. So you compared 0 with 800 and you said, yes, there is an increase. And since there is an increase, it should be deducted from the purchases and you arrived at the total cost. Okay. Now let's go to the second year because second year had opening stock as well as closing stock. And what is the sales in the second year? It is 12,500. When we arrived at the total cost, we had a purchases of 9,600. So we believed this is the cost, 9,600. Then we got this information, no, there is a opening stock. You have to add this also. So with that 9,600, we added the opening stock which we carried from the previous year, 800. And we believed that this 10,400 is the total cost. But at the year end when you took the stock, you understood that 5 units are not yet sold. So you have to knock it off. 5 into 80, 400, you are knocking it off. Now, if you just notice these two alone, because the changes in inventory means comparing the opening stock and closing stock alone. So you see the opening stock is 800 and closing stock is 400. So what happened to the inventory? Inventory increased or decreased? Inventory actually decreased. Opening stock is 800, closing stock is 400. So from 800 it has gone down to 400. It means it has decreased by 400. So what does that communicates? In scenario 1, that is in the previous year, what we have understood, when there is an increase in inventory, it will reduce the total cost. So opposite, if there is going to be decrease in inventory, it will increase the total cost. How? Look, we believed purchases is our total cost 9,600. Then only we understood, no, there is a opening stock and closing stock. We believed purchases is our total cost, but when we compared the opening stock and closing stock, we understood that around 400 worth of stock has been consumed in the current year. Is it not? Opening stock was 800, closing stock is 400. So what happened to the remaining 400? It got consumed in the current year. So that 400 will get added with the purchases. 9,600 plus 400. That's how you arrived at the total cost. So this total cost is compared with the sales and then we arrived at the profit of 2,500. So what is the message here? The message is, if there is going to be increase in inventory, that will reduce the total cost. If there is going to be decrease in inventory, that will increase the total cost. So I am putting it in the abridged form here. Sales is 12,500. From that I am going to deduct the total cost. Purchases is 9,600. I cannot compare 9,600 with 12,500. Why? Because there is some change in inventory. And what happened to the inventory? It has actually decreased. So if it is decreasing, I have to add. 9,600 plus 400 gives me this 10,000. I am deducting it from 12,500, so I get a profit. Okay, so let's summarize that now. Increase in inventory will reduce the total cost because to that extent, goods are either not yet sold or they are not yet consumed. It means they are available at the end of the year that will give benefit in future. So they become asset and they are being removed from the expenses, and in the current year there is no matching income. Okay, that's the reason. If you go by matching concept, for income, whatever expenses you have incurred. Only that should be compared to arrive at the profit. Okay. So that's what increase in inventory means. I've just captured that here. When closing stock is greater than opening stock, we say increase in inventory. And when closing stock is less than the opening stock, we say decrease in inventory. Decrease in inventory will increase the total cost because those inventories are either sold or consumed. So it has to be compared with the sales to arrive at the profit, and benefit is availed in the current year itself. It means they are not carried as asset for the future. So it has to be booked as expense.
Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2,000 rupees. But for you, I'm going to give you a special offer.
Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like auto credit facilities, letter of credit and all. So far I have introduced 7 courses of 1,999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, collateral security is a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over. Some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.